Hey everybody, Coach D with TackleTrading.com here to talk to you about the option Greeks. Whoopa! The options Greeks have everything to do with the way that options are priced. What we're looking at here over on the right is the Black-Scholes model. Now that is literally the calculus that goes into determining what the option price should be. There are several variables that go into the Black-Scholes model. You can see those down here. The variables are listed out. P equals stock price, R equals current risk-free interest rates, V equals volatility. You got the NX, which is the cumulative nominal density function. You got S equals strike price, T equals time until expiration, the percentage of a year, and ln equals natural logarithm. And all that information plugs into that formula. And the computer does all the math for you, mind you. And when it comes to learning how to trade options, we really focus our knowledge, what we need to understand, on the Greeks. These are the variables that we factor in. The first one we focus on is delta, D for delta. Delta is the sensitivity of the option premium to a change in the underlying asset at $1 increments. Delta can also be used to help us determine really quickly kind of a rough estimate of what the probabilities are of the option expiring in or out of the money. But D for delta, D for direction, and again, primarily it's how sensitive the option price is to the movement of the underlying stock in $1 increments. Theta, T for theta, T for time. That's a simple memory hook for you. Theta is the rate of time decay. And we want to understand time decay. Long-term options, longer-term options will have a slower rate of time decay. Shorter-term options have an accelerating rate of time decay. And we want to make sure we understand how time works for us on our options, whether we buy them or sell them. V for Vega, V for volatility. That one's easy to remember. Vega tells us how sensitive the option premium is to a change in the implied volatility of the option at 1% increments. Gamma has to do with velocity, and what gamma is it's the rate of change of the delta. And so gamma and delta are directly correlated. They'll say delta is for direction, and kind of the best way of saying is that speed. Gamma is velocity, how quickly delta changes. And last but not least, we got rho, which is the rate of interest rates. It's the sensitivity to the option premium to the interest rate. And again, if interest rates go up, the premium goes up. If interest rates go down, the premiums go down. Now, those are the key option Greeks. And once we understand the basics, we don't necessarily need to know how to do the math, because the way that option pricing works is it's automatically figured out between the Black-Scholes model and the supply and demand of the market. All the information will get pumped into the option pricing model. So the Vega, the Theta, the Gamma, and the Rho, and the Delta, and the stock price, all of that gets crammed into the Black-Scholes model, and boom, the option value gets spit out. And so we will always know the option pricing model and the way it works. And that, ladies and gentlemen, is the option Greeks.